Have you ever heard or wondered why there's an inverse relationship between bond values and interest rates? In other words, why if one goes up, the other one goes down, or vice versa? In this video, I'm going to explain in plain English as best I can just why that relationship exists. And I also want to share with you a few ideas that financial advisors and portfolio managers use to do their best to position the bonds in your portfolio for changing interest rate environments. A bond is a loan that an investor makes to a bond issuer for a period of time that pays interest and then has return of principal at maturity. Bond maturities range from very short, a matter of days, to a few years or several years to decades long. In your 401k or your IRA or your other kind of investment account, maybe instead of having individual bonds, you have a bond mutual fund or several bond mutual funds as a part of your overall portfolio. Whether you have individual bonds or mutual funds in your investment portfolio, this inverse relationship between bond values and interest rates applies. For simplicity's sake, I'll explain it in terms of a single bond. Let's say that you as an investor have lent a bond issuer $100,000 for 10 years at 3%, and then at the end of the 10 years, you're going to get your money back. That's pretty straightforward. So why are you seeing fluctuating values on your statement? What you're seeing on your statement, or if you're looking at your account online, why the values don't stay constant, even though you have a price you paid for the bond and it's going to pay a certain amount when at maturity, the prices in between are going to fluctuate. And what that is reflecting is, at that point in time, what would that bond fetch on the secondary market? And that has everything to do with what interest rates were at the time you bought the bond and what interest rates are now. Imagine you, I'm going to call you investor A, have $100,000 to lend out for 10 years. So imagine I, for the sake of this illustration, am the federal government. I'm looking to borrow money. I'm looking for 10-year investments. So as the federal government, the Treasury, I say, if someone will lend me their money for 10 years, I'll pay you, and this isn't today's rate, but just for example, say 3% per year for 10 years, and they'll give you your principal back. So imagine 2 years pass and you decide you would like your money back. You don't want to wait the following 8 years. There are plenty of other investors out there who will be happy to take that bond off your hands. But what they want to know is what's the interest rate on your bond and how does that compare to interest rates today? So imagine 2 years have passed since you lent the government your $100,000 for 10 years. So your bond has 8 years left on it. Investor B comes along. They're looking for a place to invest their money for the next 8 years. Let's say the federal government is paying 4% for an 8-year bond at this new point in time. So investor B, if they buy your bond, they collect 3%. If they buy the new bond, they collect 4%. So why would they buy your bond? The only way they're going to is if you discount the price of it so that between the return, the full value of the bond, and the interest they collect along the way, they get the same yield, total return back from your bond that they would have got by buying a face value new bond from the government. Now, the opposite is also true. Imagine that 2 years after you bought your 3% 10-year bond, the federal government is now borrowing 8-year money but only paying 2%. So investor B comes along. They'd like to have your 3% bond because they can only get 2% on the new bond. So if they want to buy your bond, you can sell your bond at a premium, a little more than what the face value of it was. And that way, between the return of the principal at the end compared to the price they paid for it from you, they're going to get the exact same return that they would get from a new bond. Whether interest rates have gone up and a bond's resale value is presently lower, or interest rates have gone down and a bond's resale value is presently higher, either way, it's all about equalizing the return for the new bond buyer. The extent to which a bond must be discounted or can be sold at a premium has everything to do with how much time is left on the bond. So if you've got a bond that has a few days left on it, it probably won't be affected much, if at all. If you have a bond that's got 3 years left on it, it's going to be affected more. If you've got a bond that's got 10 years left on it, even more. And if you've got a bond that's got 15, 20, 25, 30 years or more on it, it's going to be affected the most because the price of the bond that you're selling has to offset the interest that would be earned for a little period of time or for a long period of time. When it comes to bond mutual funds, there is a silver lining to rising interest rates. And that is the portfolio manager is managing the bonds in the portfolio. Some of those bonds are coming to maturity or exiting the portfolio, and new money's coming into the fund, even if you aren't buying new shares, other investors are. And that money gets put into new bonds, which are now being issued at higher interest rates. So over the long term, it can have a beneficial effect on your bond fund. Having said that, there are steps you can take, and are probably being taken by your financial advisor or your portfolio manager if you have those, to do their best to position your bond holdings for a changing interest rate environment. At any point in time, you might have a certain amount of your bonds in short-term bonds or intermediate-term bonds or long-term bonds. So if we think interest rates are likely to be going up, we're likely to be considering reallocating your bond holdings away from the long-term bonds and into the intermediate to shorter-term bond holdings. Conversely, if we think interest rates are headed down, we're probably considering reallocating your bond holdings away from your short-term bonds toward the intermediate to longer term bonds. That's just one of the many ways a good advisor adds value. If despite my best efforts to explain this, you still find this overwhelming, don't feel bad, you're not alone, there's a lot to it. That's why we suggest you work with a great qualified financial advisor. Here, and in the description below this video, is our contact information in case you'd like to consult with us.